Welcome to your daily dose of dividend. Todd made a request in the comments for Intuit, so let's take a look at that. They have a hefty market cap, over $100 billion, and they are operating in the software application industry. They are big on financial software like TurboTax and QuickBooks for accounting. And the last 10 years, they have outperformed the S&P 500 by, more than double up. And that is with dividend reinvested. Let's take a look at some fundamental data. Most of it is average over 5 years. Amazing sales growth of 15.5%, so big green check mark here. Also the earnings growth is amazing, 20%, so green check mark here. The analyst estimates for future earnings is also extremely high, 17.5%. And they have a massive return of capital of 35%. And that's probably why Terry Smith from Fundsmith likes it a lot. They have Intuit in their portfolio. They are really looking for high return on capital companies. And they have a very low debt compared to its free cash flow, only 0.8 years. And during the last 5 years, they have been buying back shares, so that's a green check mark here also. Let's take a look at some dividend data. The dividend yield is a bit low, only 0.75%. And this is quite common with high growth stocks. The yield can't keep up with the stock price. But let's see if they have room to grow it and if they are raising it in a quick pace. The payout ratio is actually low, only 20.7%, so there's a lot of room to increase that dividend. And they are growing it like crazy, actually, almost 15%. And they have been growing it for 10 years now, so that's also a check mark. So that actually puts Intuit on 9 out of 10, a great score. And I would say probably if you are in your younger years or you have started out investing in dividend growth stocks, this might actually be a good holding for your portfolio. So what do you guys think for Intuit in a dividend portfolio? Please leave a comment. If we take a look at the current valuation from Guru Focus, here we can see that it's actually, they rate it as undervalued right now. And this is compared to historical price to book, price to sales, and price to earnings, and also some future estimates. But let's also check in fast graphs how it looks in there. And here first we can see the S&P 500, so we have something to compare it to. And right now the S&P 500 is trading at a PE of 17.5. And the last 10 years it has actually grown at an annual rate of 9.5%. So that is what you can expect if you put your money in some S&P 500 index funds. But if we instead go to Intuit, we can see that they rallied from the disease period from $200 up to almost $700 in just less than 2 years. But like other tech stocks, they have come down in price quite a lot, and they are closing into being fairly valued compared to their own historical PE, which is the blue line, and the orange line is the actual earnings growth line. So if you would believe the analysts, if we project out to late 2024, you would have a total annual rate of return of 16% per year. So yeah, there you have it, guys. That was Intuit. Hope you guys found it informative. If you did, please leave a like and subscribe to the channel, and see you next time. Bye.